Hello, everybody. So today the market is up, everything is up, innovation stocks are up. It seems like we may get a Fed pivot within a month or two. We'll probably see in March. The Fed is data dependent, which means that no investment advice, but we have more and more hints that the Fed is going to go risk on. And if you're like me, you're probably very bittersweet about this because I was loving buying stocks for cheap. And when you see the price of Tesla now and how they bounced back, it's easy to feel like you've missed it, even though a lot of the innovation stocks are still cheap. In this video, I wanted to cover quite simply three stocks. They are smaller cap stocks, but three stocks which I find extremely inexpensive right now relative to their potential. I've done a video on each of these stocks, which I will link in the description. So what is the first stock that I'm actively buying right now? Well, it's HIMS. HIMS went up quite a bit actually over the past week. It seems like people are catching on. HIMS is a company that is really firing on all cylinders. They keep releasing new products. They're extremely agile. New products, shampoo, depression, anxiety, cells. They're a firm that is very, very agile, and the product appears to be resonating with the consumer very, very much so. Like in the US, they advertise on CNBC, on TV, just about everywhere. And what HIMS does is compared to Teladoc, for example, which works with your healthcare system, HIMS focuses on issues of preventative care or stigmatized conditions. Like it focuses on issues that typically insurance will not cover. Things like hair loss or need for a Viagra substitute. This is the type of issues that HIMS focuses on. So there is no insurance, and therefore, since there is no insurance, there is no administrative cost nearly as high as any other traditional insurance companies would have. That's why I think HIMS has found something interesting in the market, and they have software-like margin, right? 76% forward gross margin is software-like. And I believe they are attempting something that is really, really new in healthcare, which is to try to build a consumer brand in the word HIMS or hers. They're trying to build a consumer brand as opposed to just using the name of Viagra, Monodixil, or any of these complicated medication or molecules name. They're not using molecules name. They're using their brand and they're marketing their brand. And so I assume this will mean, to me, margins should go up. If you have a brand, margins will typically go up. And the fact that they don't have insurance allows them to move away from like a lot of negotiated prices on these generic drugs, and they're actually a low-cost leader. I would argue. If you compare the cost of their pills compared to say Viagra, which is one of their best seller, their Viagra substitute is something like between $3 and $4, while the actual pills are about 10 times as much. So they have a low-cost leadership positioning in the market. They have software-like margins. They are very, very agile, able to offer new products all the time. They're a very small company in terms of employees. The employees are very productive, and so I don't know what's not. I mean, I love HIMS. And by the way, they're expected to be profitable or to pull forward profitability, perhaps as soon as next quarter, next time they report. So that's a pretty big deal. And my conservative estimate of their growth is 69%. And in the channel, I only focus on stocks that are going to grow at least 30%. And when you compare the valuation, because this is a valuation video, look at some of the other. This is just samples, but there are stocks that are very, very heavily valued, like Celsius. You could think Celsius is kind of a novelty item, right? It's a sports beverage. Well, it's trading at 33 times earnings in one of the toughest industries ever. Snowflake, I like Snowflake. I'm invested in Snowflake, but Snowflake is very expensive at 38 times enterprise value over trailing 12-month gross profits, which is my preferred metric on this channel. So when you look at the price that you're paying for each percentage point of growth with HIMS, you're well below a 1. You are paying very, very little. This is kind of my take on the PEG ratio. You're paying very little for HIMS. Of course, this is not investment advice, but I'm very happy to own HIMS. All right. Let me move on to a second company, which I've gone through phases on Palantir. So this company is Palantir. I've gone through phases. At first, I was very, very bullish. Then I was more muted in my bull idea of the company. I was a little more muted. There was a lot of chatter on Twitter, all of that, with this company not being what it really is. And slowly over the past few months, I've gotten much bullish about the company. And it partially comes from investing the time to understand what the difference is between Foundry and Snowflake, MongoDB, Databricks, all of these other data warehouses. Once you understand that really Foundry is a software that's ahead of its time because it sits on top of data warehouses, it does not compete with the data warehouse. Once you understand that, I think you kind of understand the thesis for owning a high growth business in Palantir. Let's keep in mind that Palantir just started selling Foundry. They just started doing Foundry Con and conferences. They had a conference today actually on Foundry, which was very interesting. I got a few glimpses of it. They just started promoting this product, Foundry, and that's the main reason why most investors are invested in Palantir is Foundry. Foundry aims to become an option on the operating system of the modern enterprise. They want every company to be run like a Google or an Apple or a Tesla, a company that has its own operating system. That's what they're enabling through their ontology. I've made a full video on Palantir and many videos, but I think what's interesting on Palantir is that whether we agree or not on Foundry is really not required. Like, because to me, when I look at this company, when I look at valuation, to me, this company, you could buy this company just for the military contractor business. Like I could see this company not have any new business for Foundry. I could see Foundry staying flat for years, and this company makes sense as a military contractor business. If you look at military contractors, the Raytheon, the United Technologies, these companies have pretty high valuations, and they have, the US government and allies as their customers, so kind of the best customers in the world out there. And Palantir, to me, seems to me like it's really placing itself to be within, 5-10 years, to be the fourth military contractor, right? Palantir and Palantir's GoFam business could be the fourth stone, right? The fourth contractor for the military in the US, and it would be the software contractor, and software is key. Software is key to winning wars, and I also believe that their Gotham business is going to see a lot of demand right now with everything that's going on in geopolitics right now. I think their software, their Gotham software, their military software is going to get a lot of demand, and this is something that is often overlooked by the people who follow Palantir. So the way I look at it is Palantir is kind of a savings account. You put money in it, and it's your savings account. The stock really is so flat. Right now it's so low, I doubt it could go any lower. But you have an option on Foundry. That's an option on Foundry. And I believe Foundry, even though it may be ahead of its time, and it's got issues in how the software is sold, not in the product, but in how the software is sold, I believe Foundry could actually take off. So that's kind of my take on it. The company is almost at 30% growth. It's got a lot of deals in the past few months, so I think it's gonna do 30% growth. And again, if you compare our valuation, Snowflake is perhaps the most relevant companies to compare. Yeah, Palantir is almost 4 times cheaper than Snowflake, perhaps for a reason. But I would not criticize or I think the military business is interesting for Palantir. I really do. I think it could be a good business. And if you look at the stock, you can see it's almost at an all-time low. It's almost at an all-time low, despite it going up 5% today and going up over a few other days. It's almost at an all-time low. In one of my videos, I show that you can actually buy Palantir at about the same price that it was trading privately in the VC space in 2015. And in 2015, of course, you didn't have any of the Foundry business, any of the software deployment business. You just had Gotham. So again, Palantir, I think, is an interesting company. No investment advice. The third stock that I'm looking at is StoneCo. So StoneCo is a company that's expected to resume revenue growth this year at 55%. The economy of Brazil is very much like the US in that rates are about to pivot, right? Rates are about to go a little lower. There's a lot of optimism there. So this company may have been hurt a little bit by interest rates over there. But this is abating as well. And this company is dirt cheap. If you compare StoneCo to my reference here, Celsius or Snow, you're about 10 times cheaper on enterprise value per trailing 12 months. This company is very inexpensive in what you pay for its growth. It's cash flow positive. It's got a lot of good things going for it. What does StoneCo do? Well, I'll link a few videos in the description, but StoneCo, the best way that I have to describe it, it's about 80% Square, the payment terminals, and about 20% in a QuickBooks style ERP for small business. And their goal eventually is to have both of those be about the same size. So you can expect the ERP system to really grow fast, and that's from an acquisition that they did recently. And I think StoneCo qualifies as a stock that has essentially been forgotten. People have forgotten about it. It's been near the lows for 1+ year. It's really, to me, it seems like it has a big margin of safety. The reason why it went down, and StoneCo actually went down before the whole Fed madness, the reason why it went down is because they made a bunch of poor loans and they had an issue with the Brazilian collateral system. But they're almost done writing off these loans, and they are really being very careful about loans going forward. This is something they've emphasized many times in conference calls. They've replaced the CEO. Yes, the stock dropped because they had a major issue on collateral on loans made to small businesses, but I don't think they're going to make that mistake again. And at this point, I think the discount is way too big for this company. It's also worth noting that both Cathie Wood and Warren Buffett own the stock. And, I checked, they still own it. Both of them still own the stock. It's a very unlikely match here, but nonetheless. So very inexpensive company, and if you look, this is the chart. Yeah, it's been essentially flat, done nothing for a year. Yet it's probably projected to have about 50% growth next year. So will this company go back to its long-term trajectory if you chart it? I would believe so. I think this is an innovative company. Anyways, no investment advice. Thank you so much for watching. I appreciate any like and subscribe I can get. It really motivates me to make these videos. Thank you so much and have a great day.